Hello, everyone. Welcome to the Market and Economic Overview 2022 year-end review. A lot of people might think 2022 would be the year to forget, but the positive things about those types of environments is that various opportunities tend to come from that. And we'll talk about a few of those today throughout the presentation. My name is Brett Sebion. I'm part of the Emerge 360 team, Emerge 360 division of TrustPoint, focusing on investment management and financial planning for individuals. Heather Jordan is the managing director of the team, is also the CFP or certified financial planner, so works with all of our clients in that capacity. Throughout the presentation, you'll see that this presentation is TrustPoint branded. So remember, the Emerge 360 portfolios that you all are in are being managed by our TrustPoint investment team, making changes on your behalf based on the research and opportunities out in the marketplace. So really just want to take 15, 20 minutes to kind of chat about what we've experienced in 2022, kind of where we are today and where we might be going, and kind of what we're excited about from an opportunity standpoint within the markets. But 2022 was truly a bizarre year. You know, we thought we could get rid of the word unprecedented after the COVID pandemic. But 2022 in a lot of different ways was worse from a financial market perspective, right? And then kind of chat through what that means. The first slide here is just a 5-year chart of global stock prices. So we can go back to COVID here, had that 35% decline, the V-shaped rebound if you read or watch financial media. And really that was due to a lot of stimulus that was injected into the economy, whether it was on the monetary side or fiscal side. And then as we, developed therapeutics and vaccines for COVID, the reopening of economies followed, which was also a positive catalyst for the markets to do really well, really all the way up until the end of 2021, probably too well, right? And 2022 has been a different story. So a lot of different contributing factors, right? Think about it like, snow on a mountain, you have all these little snowflakes, which one actually ignites the avalanche, right? There's always one that ends up doing it. But a lot of ones contribute to the avalanche finally starting over longer periods of time. So again, one of them is that we came out of a very, very strong environment in a very low interest rate environment. So the Federal Reserve started increasing interest rates in 2022, which tends to act as a headwind for stocks. And then we had various inflationary pressures, which put downward pressure on economies. And then we also had the Eastern European crisis, which was kind of the final snowflake that really kind of sent markets into correction territory. So it's been pretty choppy. We'll talk about kind of different things we did within portfolios throughout 2022 to get more conservative and have a more defensive posture. But 2022 was very challenging. The next page here shows numerically how different areas of the market did. So you can see year to date and 1 year performance is the same thing. But global stocks were down just over 18% in 2022. At the lowest point, they were down about 25% at the end of September. And you can see all different asset classes within the equity markets had negative returns. Kind of picking on a few different asset classes, growth orientated sectors of the economy. So US large cap, mid cap, small cap growth did worse than value orientated equities. And we tend to see that in volatile periods and in volatile environments. But you can see there really was no great place to hide in 2022 in the equity markets. So we are all pretty used to, stocks being volatile over shorter, intermediate periods of time, right? We've been through different recessionary periods throughout our investment journey. But what has been so different about 2022 is that the fixed income or bond markets perform poorly as well. So usually when stocks are down 10, 15, 20%, the bond or fixed income part of your portfolio tends to hold its value or even increase in value, right? As investors take money out of the stock market, put money into the bond market as a safer alternative. But 2022 was very different, with bond prices selling off. And why that was really because of higher interest rates. So interest rates and bond prices are inversely related. So when rates rise, bond prices fall and vice versa. And we all know during 2022, Fed was raising interest rates, inflationary pressure is normalizing that market, put downward pressure on bond prices. And again, on the next slide, we can kind of see numerically, global bonds and US bonds were down about 11% and 13% in 2022. And you can see, just like equities, there wasn't a single asset class that had positive returns. So again, whether it was in stocks or whether it was in bonds, there was really no place to hide. There was kind of one area of the market that did really well, and that, the energy, oil and gas sector that had a good 2022. But again, being a diversified investor across different asset classes, you experienced different levels of performance within all these asset classes. Next chart here has to do with bear markets, recessionary periods. So the third column is kind of where we had currently fallen into in 2022, right? So 20+% correction is defined as a bear market, right? So in September, we at the end of September, we were down 25%. So we experience these types of bear markets, recessionary periods about every 8.5 years. And there's been 9 occurrences since 1945. The average decline that we tend to see is about down 28%. And the average length of the decline is about, in spending time in the bear market, is 11 months. Average time to recover, so back to the all-time high, is about 14 months, so just over a year. So again, history doesn't rhyme, but it can repeat at times, right? So we've been getting a lot of questions. When is this going to be over? When are we going to go back to an all-time high? Unfortunately, the crystal ball isn't super clear, right, as markets remain volatile. But we've experienced a lot of pain in this type of correction already, right? This has been going on for quite some time. Again, we are down 25% peak to trough in 2022 at the end of September. And we're coming up on a year when we talk about, time spent in this bear market, right? So that's not a call that stocks are gonna bottom from here and go back up to all-time highs. That our thinking is still kind of quite the opposite, right? We are maintain a defensive posture within portfolios, but a roadmap that I wouldn't take as gospel, but it's always good to kind of understand different periods that we've experienced when we talk about bear markets and recessionary periods. A year to forget. All right. So both bonds and stocks fell by 10% in 2022. And that is what this chart is showing. So we have US Treasuries on the left here, and the S&P performance on the bottom here. And you can see that, both areas of the market were down 10%. And that was for the first time since 1872. So just another visual of what it shows, how unique and how unprecedented 2022 was when it comes to investors, and especially investors who were in a balanced strategy, right? Investors who thought that the bond part of their portfolio would hold up when the stock market's correct. And that really was not the case in 2022. So taking kind of everything that we just talked about and applying it, how, TrustPoint thinks about portfolios, how we're allocated within our client portfolios. This is a good visual that shows that. So for example, if we were to take a balanced growth strategy, and we had no biases in the market between stocks or bonds, we would target 50% allocation to stocks, 50% allocation to bonds within a balanced growth profile. What this is showing is that we're overweight fixed income by about 5%, and we're underweight equities by about 5%. So in a balanced growth strategy, we're targeting about 45% equity exposure as we stand today and as we stood at the end of 2022. Now we make changes throughout the year. There's not necessarily a hard number. It's not, once a quarter, every single quarter we make a change. It's really dictated by the opportunity that's out in the marketplace. So we're not just going to make a change to make a change. We're going to be intentional about it and do the trade that ultimately benefits the long-term performance of everyone's account. So the next slide here kind of shows the changes that we made in 2022. So coming into 2022, we were overweight equity equities relative to our target. So in a balanced growth, we were actually at about 57.5% exposure to equities, which is getting close to the top part of that range of 60%, right? We have those 20% bands that we can work within each objective, within each profile. So we were overweight equities, as 2021 was a great year, right? And we were overweight equities for all of 2021 as well. But March, we took our first step to kind of de-risking portfolios and trimming our equity exposure as equities had done really, really well. We did so again in July and then once more in August. So we went from 7.5% overweight equities at the start of 2022, and at the end of 2022, really by August, we were 5% underweight equities. So we took, and there's some notes there that, following the initial correction that took place in Q1 of 2022, we really started looking and taking opportunities to de-risk portfolios, become more defensive when markets would rally. So it was our understanding that we were going to enter into a bear market and enter into a recessionary period. So any bounces that came in the market, and we call those bear market bounces, we were going to take opportunities to sell equities, buy fixed income, and get more defensive. So again, this occurred 3 different times in 2022. And then since our latest changes in August, we've maintained our defensive posture and took that into 2023, due to various reasons, right? Slowing economic activity, the lagged effects of rising interest rates, inverted yield curves, and growing geopolitical uncertainty. So those are the changes that we made in 2022. And after making those changes in August, that is where, we maintain our defensive posture and being underweight equities relative to our target. But as I said at the beginning of the presentation, these types of environments provide opportunities, right? So a couple things that we're encouraged about when it comes to 2023, one of them being bond yields multiple times higher than even a year ago, right? So, 2010 through 2021 was a very low interest rate environment, right? Federal Reserve was decreasing interest rates. The capacity to earn a good income on your bond investments was just not there because interest rates were very low. So now they have come back up. And yes, that put downward pressure on bond prices in 2022, but that also provided a lot of opportunity for us to allocate to certain areas of the fixed income market where we can capture that yield and capture those higher interest rates that have come from 2022. More attractive equity valuations, right? So, valuations were getting, pretty high coming out of through the 2010s, but especially after the COVID pandemic, as markets did really, really well in the back half of 2020 and all of 2021. So again, now that interest rates have gone up, markets have corrected, valuations have come back down. And again, that is more attractive. And ultimately there will be a time to reallocate to the equity markets and reallocate to those areas of the market that are undervalued. Their valuations are attractive. And when that time comes, we will make that move. Historically high levels of cash on the sidelines, which will eventually be, redeployed, right? That cash needs to be redeployed in some capacity. At some point, investors will look at the stock market and say, that's a great opportunity. I'm going to start, allocating my cash into the market. And that's a catalyst for higher asset prices. And then growing number of tactical opportunities created by higher volatility. So, we talked about the difference in returns between growth and value when we looked at the asset class returns on the equity return slide. That's an opportunity, right? So we've been overweight value relative to growth within our profiles, within the equity part of our profiles. Now, both asset classes were down in 2022, right? But value outperformed growth. So again, these types of volatile environments create those tactical opportunities that we hope to capture, and that benefits long-term performance of our client accounts. So just a couple things of what we're encouraged about going into 2023. And then the last slide here, just want to say, thank you to everyone. 2022 was a rough year, right? And there's a lot of volatility. But thank you for staying focused, patient, and disciplined, and through that volatile environment, and really trusting us as a partner. We value everyone's relationship, and would be, always, if anybody has any questions about the markets, has any questions about their account, feel free to always call, and we can have that conversation. So again, if there's anything in the material here that you'd like to talk further about, be more than happy to. Or if there's anything that we didn't talk about, economic related, market related, and you have additional questions, would be more than happy to answer those. So hope everybody enjoyed that. Again, thanks everyone for sticking with us and trusting us, and hope everyone has a great 2023. Thank you.